stocks. BHP Billiton, soon to be renamed just BHP, it seems, the world's largest diversified natural resources group. Remember, it's got iron ore, it's got copper, and it's got oil and gas. It's got a market cap of 1.18 trillion rands. You've got to add together different pieces because it's listed in London and South Africa, in Australia and America. Price earnings ratio 33.29, dividend yield 3.58. Share price will reflect that it's hovering at around 200 rands a share, not going anywhere fast. It did have a better 2016. Wayne, there's some activist investors giving them a hard time now. What's that all about?
Look, I wouldn't worry too much about it. They're saying, sell the petroleum assets, cut out your dual listed structure, the share price will go up. And Billiton says nonsense. We look at this regularly.
Because they sold a lot of stuff already and they spun off South 32, which we'll talk about. So they just got the big three. Now they want one leg of the big three to go.
But that was the story when petrol was low, you know, when oil was low. So now I wouldn't worry about this too much at all. I think it's maybe a bit of PR exercise for Elliott there, get a bit of news, get a bit of exposure.
Because Elliott, these are the kind of robber barons that come and buy 5 or 6 or 7% of your shares, demand a seat on the board, make public speeches about how useless you are,
I wouldn't worry about that. Okay, Billiton, very diversified. They weren't as bad off as the other guys, Anglos in particular.
Because they had the best quality assets to start with.
They were just lucky. They made that huge bid for Rios that didn't work at the top of the cycle.
Just as
if
well
that deal had have worked, Billiton might not have even been around.
Because they would have had all the assets, but they would have had
colossal debt, massive new shares in issue. So they were lucky. It always, you know, you always think Billiton, oh, it's the best management. They were just lucky. Their big deal, which was the biggest of the whole lot, just didn't work. So they were lucky. But let's put that aside now. Billiton, good quality spread. Maybe not as cheap as Anglos, which we'll talk about now, but if you take current ruling prices for their commodities, and we assume that the current prices stay in place for a year, Billiton's at about a 9 forward price earnings ratio, which is okay for a big diversified miner.
So you can buy them on the assumption that you'll see solid cash flows, reasonable profits, and dividend
yields will go up, dividends will come back. They're not spending capex. Capex is now an anathema. You don't even mention capex in a mining company.
Because it's important that people understand that even though the mood isn't all that great, it's not like they aren't still selling.
No, they're selling and they're making money.
Truckload.
And they're making money at current levels. They weren't making money a year ago, but at current commodity prices, they are making nice returns. And I think the current cycle will stay in place for another year or two.
So now we need to go hot or not, and the question becomes 200 Rand, you're hot on this one?
I'm hot on this one.
Okay, I'm going to pass and go not hot. Let's